I'm here with Andy Hattman, a portfolio manager on our tax-exempt funds. Andy, the first quarter was certainly an interesting time in fixed income. Can you talk a little bit about how munis fared during that environment?
Sure, Jim. It certainly was an interesting quarter for fixed income. What we saw in the muni market is that the market was off slightly. However, on a relative basis, the muni market actually outperformed other fixed income asset classes. The story in the first quarter in the muni market was a bit of a tug of war between one very big headwind and several tailwinds more unique to the muni asset class. The big headwind was rising treasury rates, which put a damper on returns across all of fixed income, and munis were certainly no exception. However, with munis, there were several tailwinds that helped buoy returns. The first big tailwind for munis was heavy investor fund flows into muni mutual funds. We believe that many investors anticipated higher tax rates in the future and plowed money into muni mutual funds in the first quarter. The second big tailwind that helped the muni market was an additional round of stimulus. This final round of stimulus that happened in the first quarter provided direct aid to state and local governments and really helped muni borrowers shore up their finances. The last tailwind that helped the muni market was tightening credit spreads. So while treasury rates and even AAA muni rates were rising, credit spreads were tightening, which provided a bit of an offset and kept muni rates in check during the quarter.
Thanks, Andy. Great insights. Could you also talk a little bit about your very disciplined approach to managing tax-exempt funds?
Our disciplined approach is really tied to our philosophy. A big part of our philosophy is that we focus on yield and try to have a yield advantage relative to our peers. The reason for this is really simple. Historical data has shown that the best predictor of future returns in fixed income is starting yield. So we think that if we're able to have a yield advantage versus our peers, that good things will happen over time. The way we're able to get this additional yield is by taking on additional credit risk. However, we're completely fine doing so because we believe we have the team and the process that has been built over decades that allows us to build portfolios bond by bond and focus on taking on additional credit risk and mitigating that credit risk. So what we're able to do with a very well-defined philosophy and process is bring a very disciplined approach to investing in fixed income.